Welcome back to another video. In this video, we are going to go over short selling. We are going to break down what is short selling, how short selling works, ETB versus HTB, the cost of short selling, and I'm going to go over some shorting examples. All right, so let's get started. What is short selling? So short selling or shorting is a bet that a stock's price will go down. You basically profit if the stock goes down and you lose money if the stock goes up. So basically a lot of people are familiar with the idea that you can make money when a stock's price goes up. That's what everyone knows trading as. So basically if you buy a stock at $10 and that same stock goes to 15, you automatically make $5 per share, right? That's what everyone knows about trading. But what a lot of people do not know about trading is that you can also make money when the stock price goes down, right? So let's say you short a stock. I short this stock at 10. If this stock goes below 10, let's say it goes from 10 to $8. If it goes to $8, at this point, I am up $2 per share. So you can also make money when a stock's price goes down. That is known as short selling, right? So let's dive more into it, right? So when you're typically going long, you're anticipating that the stock's price is gonna go up. So you buy low, let's say you buy at 20, and you're looking to sell at a higher price point. So if you buy a stock at 20 and you sell at 30, you made $10 per share. That's typically going long. Short selling is the opposite. It's you sell the stock here, let's say you sell at 50, and then you rebuy at, let's say, 10. You just made $40 on the trade. Now the question people have is, how do you sell something or how do you short something that you don't own? That's what confuses people. So I'm going to break down a few different examples so you have a better understanding. So if you don't understand it on the first example, please be patient. You'll maybe get it on the second or third example. So how do you sell something you don't own? So the idea is you borrow the shares from another shareholder through your broker and you sell at a high price and aim to buy at a lower price to basically earn a profit. So basically, you guys can see this stock was at $58. So when it was at $58, one person owns the stock. Now, whenever you own a stock, your broker is the one that's holding the inventory. Your broker is the one that's holding that stock. So let's say someone named Andrew bought one stock at $58. Your broker is the one that's storing the shares. Now you might come in and say, you know what? I want to short the stock. I think this stock is going to go down. So what you do is you borrow your broker's inventory, right? And then you automatically sell the stock. When you sell the stock, you aim to rebuy it at a lower price. So if you sell it at 58 and you buy it at 42, you made a profit of $16 per share. Once you buy it back, you typically return the share back to your broker, so the broker's inventory stays the same. Like I said, I'm going to break down a lot more examples so you guys have a better understanding. So if you didn't understand it yet, just stick through the whole video and I promise you'll have a better understanding. So let's use a general example. Let's use an iPhone example. Let's say this is Bob. Let's say Bob owns an iPhone 10, right? Let's say today the value of an iPhone 10 is $1,000. So at this exact moment, the value of an iPhone 10 is $1,000. Let's say this is John. John thinks that the value of the iPhone is going to decrease in the next week because Apple is announcing a new phone. They're announcing a new phone, and since they're announcing a new phone, he predicts or he assumes that the price of this phone is going to go from $1,000 to, let's say, $700, right? So what John does is he goes to Bob and he says, hey, listen, Bob, let me borrow your iPhone and I will return it to you in a week. Bob says, okay. Bob takes his iPhone and he gives it to John. What John does immediately is John sells the phone right now to someone, or he goes online and he gets rid of it. So when John sells the iPhone, what tends to happen is John immediately gets $1,000. Now at this point, John has $1,000 and John owes Bob an iPhone. So let's say a week goes by, right? When a week goes by, Apple announces a new iPhone and the old iPhone 10, right? The value does drop. The old iPhone drops to 700. As it drops to 700, what John does is John now uses the $1,000 that he originally got and he goes and buys the iPhone for 700. Now when John buys the iPhone for 700, John has $300 left over. And as he gets the iPhone back, he returns it to Bob. Bob gets his iPhone back. John made a profit of $300. Now, obviously, if the value of the iPhone did not go down, it went up, John would have to pay more money, right? Let's say the value of the iPhone went from $1,000 to $1,200. At this point, John would have to dish out an additional $200 to buy the iPhone and return it to Bob. So basically the idea of shorting is you're borrowing the shares, right? You're selling them to the open market immediately, right? And you're going based off the idea that the value is going to go down and you make a profit if or when the value actually goes down, right? Now let's go over the process of short selling in the trading world. It's a little bit different. It's the same idea, but it just has a little bit difference. Now, here is the trader. The trader thinks that the stock will go down, right? Next, we have a broker. The broker is the one who lends the shares they're holding from the buyer. And then obviously we have the owner of the original shares. So let's say we have Bob. Let's say we have John, okay? And let's say this is just the broker, right? Now what happens is, once again, let's say Bob buys one share at $100. Now when Bob buys one share at $100, right off the bat, that share is being stored by the broker. The broker is the one holding it because the broker is the one facilitating the trade, right? So the broker holds that share. So at this point, Bob owns one share at $100. John kicks in and says, hey, I think this stock that's at $100, right? I think it's gonna go down. So what John does is John says, you know what? I want to short this stock. So John goes to his broker, right? And he requests to borrow the shares. Now, when I say he goes to his broker, I do not mean John has to physically go to his broker or give his broker a call. John can just go on his phone and hit the sell button. If John hits the sell button, he is telling his broker, hey, you know the one share you have from Bob at $100? I want you to sell it right now. Like, sell it right now. So what the broker does is the broker sells it. Now the question people have is, why would the broker sell it, right? The broker sells it because A, they make commission, right? And they charge a fee known as interest on shorting, which I'll get into in a bit. So once again, the reason the broker lends out the shares is because they charge a commission and they charge interest. Now, Bob obviously doesn't know his share is being borrowed or not, because at the end of the day, if Bob needs to sell his share right now, the broker will immediately make it available. So Bob has no idea what's going on. Everything that's happening is on this side. Now, at this point, once again, the trader, known as John, requests to sell one share at $100, and the broker listens to it and he sells one share at $100. Now, when the broker sells one share at $100, there's two things the broker gets. One, the broker gets the $100 for the sale. And two, the broker collects a deposit from John for $100 as well. Once again, the broker, right, gets $100 for actually selling the share, and the broker also gets a deposit from John for $100, right? If the broker was selling the stock for 200, he would ask for $200 deposit. If he was selling it for 300, he would ask for a $300 deposit. Now at this point, the broker has a total cash of $200, right? But the broker needs an iPhone in return. John is negative $100, and John needs to return 1 share back to the broker. Now, how does everyone make money? What's the process? So let's say the stock goes from $100 to $50. The stock goes from $100 to $50. John goes on his platform and says buy. Now, when John clicks the button buy, he's instructing his broker to buy 1 share at $50. Now, what the broker does is the broker uses the money the broker has from the deposit and the sale of the share and uses that to buy 1 share. So at this point, the broker has $200. Once again, how does the broker have $200? Remember, the sale of the share at $100 and a deposit from John for $100. So in order to buy 1 share right now, the broker needs $50. So what happens is the broker minuses $50 from the cash they have, and how much is left over? $150. $150 is left over. So what the broker does is the broker takes this $150 and it goes to John. So John gets his original $100 back, and on top of that, John gets $50 profit. The broker gets their shares back, and the broker makes their commission, and the broker makes their interest. So John is happy, the broker is happy, and Bob basically has no idea what's going on. Now, if Bob ever needs to sell his shares, the broker will make it available and give it back, because obviously Bob's shares are not the only shares the broker is holding. Usually they're holding other people's shares or other company shares, and all the shares are in a pool of a basket, right? So that's the process of short selling on the back end. Now, let's say, right, the share didn't go to 50. Let's say the share went to 150. If it went to 150, now same concept. If it went to 150, what tends to happen at this point? At this point, the broker does the same thing. It uses the $200, minuses 150, the broker gets their share back, and how much is left over? $50. John gets his $50 back, only he doesn't get 100 back because he now lost money. That's why the broker requests a deposit. The broker did not ask for a deposit. The moment the stock goes above $100, the broker now has to chase John for money. But the broker does not want to do that, which is why the broker requires a deposit to make sure that they have some sort of leverage, to make sure that if the stock goes to a certain point, they are protected. The broker is not in the business of chasing you for money. The broker just wants to profit on commission and interest, especially on a short sale. Let's go over some more examples and break it down. So, entering a short position. When you're entering a short position, it's kind of the opposite of buying. All you're doing is you're selling 100 shares. Let's say in this example, we want to sell 100 shares at 170. Once again, what happens is we go negative 100. Our account says negative 100. If I was buying 100 shares, it would say positive 100, right? But in this situation, it's saying negative 100. So negative 100, I'm selling 100 shares at 170. I'm instructing my broker to sell 100 shares at 170. So what my broker does is my broker obviously wants a deposit, right? So my broker gets a deposit of $17,000 from me, right? That's the first money the broker gets. And then the broker also sells it around 170. So the broker also is holding my deposit, right, of $17,000 and $17,000 for the sale. So the broker at this point, right, has about $34,000. The broker doesn't care about $34,000. The broker cares about getting the shares back, making their commission, and obviously the interest. Now, let's say the stock goes down to 130, and you're like, you know what? The stock is at 130. I am ready to get out of my position. So what you do is you buy to cover. You hit the buy button. You buy 100 shares, and the only thing you have to do on your platform is hit sell and then buy. When I hit buy 100 shares, it offsets the negative 100. My position goes to 0, and I just made a profit of $40 per share on the trade, right? That's the concept of short selling. You are making money when a stock goes down. Now, a few things you have to keep in mind with shorting is that in order for you to short shares, you have to borrow them. So the tough part about shorting is the concept of finding shortable shares. Shortable shares need to be located by your broker, and they can be either easy to borrow, ETB, or hard to borrow. Now, that's the tough part about shorting, right? If you want to short shares, remember, you have to borrow them, right? If you have to borrow them, the brokers sometimes may not have them. And if they don't have them, those shares are HTB. They're hard to borrow shares. If the broker does have them, they are ETB, easy to borrow shares. So what does that mean? So if you guys take a look here, you guys can see different stocks: Roku, ETB, easy to borrow; OSTK, hard to borrow; Snap, ETB; BYND, HTB, right? These are easy to borrow, hard to borrow, right? Now, what's that mean? Let's dive into a little bit more in depth, right? Easy to borrow shares are shares that are easily available to borrow because there's high quantity of outstanding shares and easy accessibility, right? So if a stock is easy to borrow, it's very easy to find the shares. It's very easy for you to hit sell and immediately get filled. You immediately get the shares. Hard to borrow are shares that are hard to locate because the broker doesn't have any inventory available or has very low inventory. If the broker finds any hard to borrow shares, they will charge an additional fee, which is known as a locate fee. So some brokers, right, or sometimes all the brokers are going to have a hard time borrowing some shares. So for example, BYND, for anyone that's familiar with BYND, BYND has been HTB for a very long time. Why? Because a lot of people have been trying to short it. Since a lot of people have been trying to short it, it's been extremely hard for you to find shares. So a lot of brokers will showcase on their platform that BYND is hard to borrow. When is BYND not going to be hard to borrow? When a lot of people stop shorting it and there's more shares available. Now, if you want to borrow BYND, you're going to have to request your broker to locate the shares. You'll have to say, hey, I really want to short BYND. Can you locate these shares for me? Now, what you have to understand about the locating aspect is if they locate the shares for you, they're going to charge a fee, right? They're going to charge a fee. Locating shares on shorting is not cheap, depending on what stock it is. Some locate fees are extremely high, some are low, but it all depends on the stock. It all depends on the demand, right, that's going on with the stock at the moment. So that's something you have to contact your broker. Now, if you're someone that's first starting out, I do not recommend you to go after stocks that are hard to borrow. Do not try to short something that's hard to borrow because the fees itself automatically in the beginning are going to put you down. They're already going to put you in the red because you're paying a lot of high fees. Yes, once you become a more advanced trader and once you get a better understanding of the market and you're more confident, then you can maybe get into that. But starting out, I do not recommend you trading hard to borrow stocks or trying to short them, okay? Now, what are the costs of short selling? There's costs associated with short selling. Short selling is similar to a loan. You're basically borrowing shares from your broker, and whenever you take out a loan, there's usually an interest rate associated with it. Whenever you short a position, there is an interest rate associated with it as well. So basically, if you short a stock, number one, shorting is obviously right off the bat, you're going to pay interest. That's number one, right? Number two is if it's hard to borrow, right, you're paying the interest plus you're paying the locate fee, right? So keep that in mind. Now the interest, the way the interest works, it depends on the broker, but the concept is very similar. Some brokers have a higher interest rate, some have a little bit lower interest rate. You can always call your broker, try to negotiate it, and try to get the fee lowered. Now the interest rate is on a daily basis, right? So they don't charge it on a yearly basis. It's not a lot if you're holding a position for a short period of time, but if you hold a position for a year, some brokers charge 7%, some charge 10%, right? So if you short a position for one whole year, that one whole year is going to cost you maybe 10% depending on your broker, right? It depends on your broker. So you have to find out what they're charging and you have to factor that in. Usually it's 7%, it's 8% for the full year. So that 10%, if you hold the position for a day, that gets divided by the trading days, right? So it gets divided by how many days you're holding it, and that gets factored in. So depending on your broker, you have to find out what they're charging for the cost associated with shorting, what their interest rate is, and just having an idea of that is very important. And once again, you can always call your broker and negotiate that fee and lower it. Next, what is a short squeeze? So a short squeeze is when a stock's price rapidly increases, which then triggers a rush of buying pressure, known as covering among short sellers. So basically, what tends to happen is if a lot of people are shorting a stock at this point, typically if the stock breaks that point, those same people are now maybe exiting. If they're exiting, their stop losses are getting hit, they're covering their position, that is going to create aggressive buying pressure. That is going to take a lot of traders and make them aggressively start buying. That aggressive buying pressure will drive the stock price up. Once again, if you short, you are selling. So you are creating selling pressure. Now, if you are exiting, right, the short position, so think about it. Let's say you shorted the stock at 10 and the stock is now at 11. For you to exit, what do you have to do? You have to buy. So if a lot of people start buying at this point, right, because the stock is maybe increasing or it came out with good news or whatever the case is, that automatically triggers a lot of buying pressure, which creates a short squeeze, right? Understanding the levels of where short squeeze exist or where they can, kind of kick in is extremely important, because when short squeezes happen, a stock tends to rally up very, very aggressively. All right, so a few key tips to keep in mind about shorting is, number one, you need to short, you need to have a margin account. So in order to short, you need to have something called a margin account, and I'll break down margin accounts in the upcoming lessons. But you need to have a margin account if you want to short. Next, when you're shorting, you have to understand there's infinite upside to shorting and limited downside. Now, this is not something that I'm putting here to scare you or put you down, but what you have to understand is if you short a stock at 10, right, you can lose more than 10. So you have to understand what stocks you're trading. Now, if you start shorting penny stocks that move up 100 or 200% overnight, right, that's not a good idea, especially if you're starting out. Once you become a more advanced trader, cool, those techniques are totally fine. But starting out, please be careful shorting, because if you short the wrong stock and that stock ends up going from, let's say, $2 to $7 overnight, you could lose more money than you potentially invested. So please be careful on what you short, especially when you first start out, guys. Next, be careful shorting hard to borrow shares, especially when you first start out, because there's a lot of costs associated with it and it's very risky. So obviously when you short, you're getting hit with commission, right? And you're getting hit with a fee if it's a HTB, hard to borrow stock. So starting out, I do not recommend you to trade stocks that are hard to borrow. I do not recommend you to trade stocks that are extremely volatile on the shorting side, because you could lose more than you invested. If you hold a short position overnight, understand the risks associated with it, because some stocks with basically lower market cap, as I mentioned in the previous lessons, could spike up. So if you're trading a $2 or $3 stock that has, let's say, a $50 million market cap, right? You have to understand that these type of stocks are the stocks that go up 100, 200%. These are the stocks that also go down 50, 60% in a day or overnight. So shorting them, you have to be very, very careful. I do not recommend for you to do so when you first start out. And then finally, to short, you need to sell and then buy. The concept of shorting is you're first hitting sell and then you're hitting buy. Just to wrap everything up, shorting is not a bad thing in the market. Another alternative to shorting is something called puts, right? That's where options kick in. I'm going to break that down in the upcoming videos. and I'll dive into that, but that's another alternative. Shorting isn't bad, shorting is good when there is an opportunity, because remember, stocks don't always go up, they'll also go down. And if you can master the idea of making money when a stock goes up and down, that will allow you to make money more times and put you at an elite level.